You know, it is now, in all respects, my great honor to introduce our next speaker and our keynote for the conference, Federal Trade Commissioner Julie Brill. Julie's the newest of the nation's 5 Federal Trade Commissioners. That's a presidential appointment, Senate confirmation. She's also the longest traveling person today, that she came from New Hampshire yesterday. I'd like my introduction to match the efforts that she made, and based on that, I hope my next conference has to do with the problems and perils of airline deregulation. Her credentials and experience are impressive. She's a Princeton undergrad, earned her law degree from New York University School of Law, which then she was a Root Tilden Public Interest Fellow. She clerked for a federal district court judge in Vermont, had a distinguished career in the Vermont Attorney General's office before leaving last year to become Senior Deputy Attorney General and Chief of Consumer Protection Antitrust for the North Carolina AG's office. I think, though, what really makes, for me, this a great pleasure is more than Julie's credentials, it's the lifetime of service and the way that she's chosen to make a career that makes it a great pleasure for me. Julie spent 20 years in the Vermont Attorney General's office. She is known, before she got this post, as the best known Assistant Attorney General in the country because of the efforts that she's made as a result of that. She received a Marvin Award as one of the country's top assistant AGs. She really was and is, or was before she got this post, one of the main true leaders, because the AG's offices work together. And things like this, as I'll talk about later, doesn't happen without great staff. And Julie always has been one of the leaders for all of the states, even though she was in Vermont. She served as Vermont's in-house lead counsel in the national tobacco litigation, successfully lobbied the Vermont legislature and Congress on issues like data privacy personal financial records, and the pharmacy's industry's access to doctors' prescribing practices. One of the things that I did once I got Julie to commit to making the trip out is I talked to Bill Sorrell, who's my colleague, the Vermont Attorney General, and I said, Bill, tell me 2 things that you or I would want a Montana audience to know about Julie Brill. And one was on the national level that he gave me, and one was on kind of more close to home. The national level, Bill said that, you know, one of the larger banking concerns had come up to Bill. This was a couple years ago, and said, when I'm going to be a part of a panel where Julie Brill is on that panel, I literally lose sleep for nights before it. And that's because of her level of preparation and understanding of the issues that states and state AGs grapple with on a regular basis. And the other was, he goes, here's one example of a case, because a chunk of what we do is mediate and work with individual cases. Told me that in one case she handled in Vermont, a single complaint to their consumer assistance program dealing with MCI. And so that one complaint, she ended up doing the investigation, and it was dealing with MCI accessing Vermonters' credit histories. And what she got was the maximum of the $100 penalty. But what she did is that maximum of $100 penalty was for 14,000 Vermont households. So one individual making a complaint got $1.4 million back to the consumers of Vermont. She was nominated ultimately to this post and which is another of the great things about Julie Brill, not because of political connections, not because of anything, but because of the way that she's lived her life and the track record that she's made of 20 years, 20 plus years of watching out for consumers all across the country. Federal Trade Commission, it's tasked with protecting America's consumers, and I think with Commissioner Brill on the commission, that we can all sleep a little bit better than some of those people that have had to face her in a panel. So please welcome me, or join me in welcoming Commissioner Brill to Montana.
Wow, I wish my mother had heard that. I'm just going to put this here. So thank you, Steve, for that incredibly kind introduction. And thanks for sponsoring today's conference. I'm really pleased to be here to share my views on what I think financial reform means for all of us here far beyond Washington, D.C. Before I joined the Federal Trade Commission, I spent, as Steve mentioned, many, many years, I did start when I was 5 years old, working to solve consumers' concerns at the local level, like so many of you are doing. And I know that you, General Bullock, in particular, have been a real leader on consumer protection issues here in Montana. So I know the good work that all of you are doing, and I know the challenges that you face. In my talk today about financial reform, I thought I would discuss three things. First, I'd like to talk about how we found ourselves in the financial crisis in the first instance. That is, I'd like to discuss some of the problematic practices, that is, problematic financial practices that led to the current economic situation. Second, I'd like to talk about Washington's response to the crisis, and specifically the creation of the Consumer Financial Protection Bureau. In particular, I'd like to share with you my thoughts about how the Bureau, the Federal Trade Commission, and the states can work together to address some of the issues that caused the financial downturn. Finally, I'd like to highlight for you some of the ways that the Federal Trade Commission and the states are now taking the initiative through our enforcement and regulatory efforts to keep consumers from falling prey to the types of scam artists who target people who are suffering financially, and to begin to address some of the systemic problems we've seen in the past few years. So let's talk about the crisis. As you all are keenly aware, we're in the midst of the worst economic crisis since the Great Depression. While economists may proclaim that the recession is technically over, and while the stock market is doing better than it was, say, 2 years ago this time, there are some very serious economic problems that remain. Domestic output levels remain anemic. National unemployment rates, thankfully in Montana, the unemployment rates aren't quite so bad, but nationally, the rates continue to hover at near double-digit levels. Depressed property values in many areas around the nation continue to plague homeowners, and consumer credit delinquency rates are near an all-time high. So while things may be looking a little brighter for Wall Street, there are many consumers on Main Street who continue to suffer the adverse effects of the financial meltdown and for whom the future still looks pretty bleak. So how did we get here? What were the causes of what some are calling the Great Recession? Economists and historians will be debating that answer, or the answer to that question, for years to come. But while the causes of the financial crisis are many and are really complex, I think that most everyone can agree that one major factor was the dramatic changes in the real estate market over the past decade, particularly with respect to borrowers who previously could not afford to own a home. That's the subprime market that we were talking about earlier this morning. These changes to the subprime market were theoretically beneficial to a large number of consumers who, because of their income, their employment status, or their credit history, previously were unable to qualify for real estate loans at an affordable price. So the financial industry created new subprime loans with below-cost teaser rates and pick-a-payment features that were structured to allow these borrowers to afford a mortgage, at least initially. But after a few years, the loans were designed to increase dramatically in cost. These subprime loans did make sense, but only as long as a couple of factors held true. First, the borrower would have to fully understand the terms of the loan, and in particular, what would happen to the interest rate after the first couple of years. Second, the value of the borrower's home would have to continue to increase through the loan period, through that low-cost initial teaser period, after which time the consumer hopefully could refinance with a more conventional loan and so avoid the high interest rate adjustments that were going to be coming. But these two conditions often were not met. Many borrowers did not fully understand what would happen to their loans in 2 or 3 years. Many were also unknowingly placed into these loans by brokers who enjoyed yield spread premiums. As Gary mentioned this morning, these were essentially higher commissions, he used a different term, for placing the borrower in more expensive loans, even though the consumer would have qualified for a more conventional mortgage. Some of these loans also suffered from other problematic practices that helped increase the payout for brokers and lenders, such as inflated appraisals that made the home seem like it was worth more than it really was. Now, that allowed the consumer to borrow more, but it also allowed the broker to receive larger commissions than the true value of the home could really support. Poor or non-existent documentation of income, again, allowing for larger mortgages and, of course, larger commissions. And other high fees that may have been hidden or unfairly charged to the borrower. There were many folks who wanted to do something about these shadier practices that were rampant in the subprime market. The state attorneys general, who often hear about problems on the local level first, did take some strong action. For example, in 2002, a number of state attorneys general pursued mortgage lender Household Finance. That's the company that loaned to Tommy and Marcia Myers that Gary talked about this morning. They sued them over concerns that Household Finance had violated numerous provisions of state consumer fraud acts and financial regulations by misrepresenting loan terms and failing to disclose material information to borrowers. In some cases, after monthly payments jumped dramatically, consumers were put at risk of losing or did in fact lose their homes. The state attorneys general believed Household Finance misrepresented the interest rates on mortgages, points, and other fees paid by the consumer, and didn't tell consumers if they paid off their mortgage early that they'd be charged an additional prepayment penalty. Household Finance ultimately settled with the state AGs for $484 million, the bulk of which was used to provide restitution to consumers. But Household wasn't the only predatory lending case that the states pursued. A few years after the Household case, the states pursued a similar one against AmeriQuest. At that time, it was the nation's largest subprime lender. Now, the allegations were similar to those that were made in the Household matter, and after reaching a $325 million settlement with the states, AmeriQuest pretty much disappeared from the subprime mortgage market. Then in 2008, the state attorneys general announced a settlement with Countrywide Financial, the subprime lender that surpassed AmeriQuest as the nation's largest, in which Countrywide committed $8.7 billion, that's with a B, towards directing loan relief to victimized consumers. Once again, the allegations against Countrywide were pretty much the same. It had engaged in a wide range of deceptive practices and had originated loans that were structurally unfair and ended up being unaffordable for borrowers. So as you can see, the states have not shied away in the least from taking on the big players. And the states were not alone in their efforts. The FTC also took action against inappropriate lending practices during this period. In the past dozen years, the Federal Trade Commission has brought over 25 actions against companies and individuals in the mortgage lending industry, involving firms both large and small, located throughout the nation. Some of these cases involved mortgage lenders who, we alleged, advertised low interest rates and low monthly payments, but failed to adequately disclose that the low rates and payment amounts would increase substantially over time. Other cases involved mortgage lenders and brokers who deceptively marketed loan costs or other key loan terms, such as the existence of a prepayment penalty. For example, in 2002, the Federal Trade Commission announced a settlement with Citigroup to resolve allegations that its subsidiaries had engaged in systematic and widespread deceptive and abusive lending practices. According to the FTC's complaint, the defendants had deceptively marketed optional credit insurance to consumers. This process was known as packing the mortgage with these optional bells and whistles that the consumers really didn't understand but brought in a lot of money to the lenders and the brokers. And as part of the settlement with Citigroup had to provide $215 million in redress to consumers who had bought the deceptively marketed optional credit insurance. Now, all of these efforts by the states and the Federal Trade Commission represented very good work, but it wasn't nearly enough. The honest truth is that everyone probably could have done more to try to stop the inappropriate lending practices that served as one of the causes of the financial meltdown. But one of the biggest problems faced by the Federal Trade Commission and the states in trying to enforce some order in the subprime market during the past decade was that they didn't have full authority to address all the problems and all of the players. The Federal Trade Commission does not have enforcement power over banks, savings and loans, and other depository institutions that originated and procured many of the questionable loans that resulted in the market meltdown. The federal banking regulators do. The states tried to pass laws designed to ensure that banks did not engage in predatory lending, but their efforts were thwarted by the same federal banking regulators. These federal regulators, that is, the federal banking regulators, took the position that the state laws against predatory lending didn't apply to banks or their mortgage subsidiaries. And while the federal banking regulators fought to keep the states out of the consumer protection business, at least as far as the banks were concerned, they failed to fill the gap in regulation with uniform, market-wide standards that would have ensured that lenders did not engage in fraudulent, deceptive, or unfair lending practices. Indeed, according to the current chairman of the Federal Reserve, Ben Bernanke, one of the key missed opportunities to avert the problems in the subprime market was the Federal Reserve's failure way back in 2002, it seems like eons ago in this financial crisis, to follow through on some important proposals that would have strengthened the federal lending regulations, or even to enforce the regulations that the Federal Reserve did come up with. According to Mr. Bernanke, a more aggressive approach by the Federal Reserve back in 2002 could have avoided many of the abusive practices by all players in the subprime market that were partly responsible for the financial meltdown. So in the end, the efforts of the states and the Federal Trade Commission were like a finger in the dike, and we just couldn't hold back the floodwaters of economic devastation. Now, it's very important to point out that the financial crisis wasn't just caused by inappropriate lending practices in the subprime retail mortgage market. In the secondary market, where investors were looking to purchase instruments that had a little bit more risk and therefore a bit of a larger payout, the subprime mortgages were bundled into residential mortgage-backed securities and something called collateralized debt obligations. These securities were sliced and diced into risk classes, or tranches as they're called, and resold to investors. The rating firms like Standard & Poor's and Moody's played an important role here, blessing the mortgage-backed securities and the CDOs with good ratings, despite the level of risk that they really entailed. A great deal of the secondary market passed through investment banks and other large financial firms, which were regulated lightly or really unregulated. Few of the regulators that might have been involved with these other large financial institutions, and few within the firms themselves, seemed to understand how risky the underlying subprime mortgages were, and therefore how much risk these institutions were actually taking on by trading in these financial instruments. So the inevitable happened. As the real estate markets cooled and consumers were unable to refinance their adjustable rate mortgages after they reset at higher rates, tens of thousands and then hundreds of thousands of consumers began to default on their subprime loans. This caused a collapse in the markets for these securities and the collateralized debt obligations that were backed by the subprime loans. The securities basically became worthless. So the banks, the municipalities, the insurers, the pension funds, and others who had invested in these financial instruments quickly saw their asset portfolios evaporate. The rest we know only too well. So now let's turn to the financial reform that took place in Washington. The bill is called the Dodd-Frank Wall Street Reform and Consumer Protection Act, and it was designed precisely to tackle big picture issues like the one I've just described. The act aims to accomplish these goals through a fundamental restructuring of the federal financial regulatory environment. The idea is to streamline the regulatory process and, at the same time, increase oversight of specific institutions that, because of their size or the nature of their holdings, can present risk not just to their own shareholders, but to the larger economy as well. The new agency, the new agency charged with protecting consumers in the credit and financial markets will be known as the Bureau of Consumer Financial Protection. The Bureau will have wide-ranging authority. It will have rulemaking authority with regard to unfair, deceptive, or abusive practices by banks and pretty much everyone else that provides consumer financial products or services. The Bureau will also have the right to examine the books of most of these institutions and enforce the laws against them if they're found to be in violation. That's not to say, however, that the Bureau of Consumer Financial Protection will have all the fun. There will be critical and ongoing work for the traditional consumer protection agencies, that is, the Federal Trade Commission and the state attorneys general. This means that there will be 3 cops on the beat, which in my view is a very good thing. I expect the Federal Trade Commission and the states will be full partners with the new Consumer Financial Protection Bureau, with each of us leveraging our own areas of expertise and our own jurisdiction, while coordinating and working closely with each other to ensure that consumers are fully protected in the realm of financial services and products. I like to think of this combined approach as a 3-legged stool, one that can stand only when all 3 legs equally carry the load and are firmly planted on the ground. At the FTC, we're eager to move forward with our consumer protection partners to ensure that consumers make it through this financial crisis and to ensure that something like it doesn't happen again. But there's a practical reality that we have to confront. The Bureau of Consumer Financial Protection is still in its gestational stage. The Bureau will not be up and running until next July 2011 at the very earliest. And even then, the new agency will no doubt take some time to become fully operational and up to its full regulatory, enforcement, and supervisory capacity. So I believe it is critically important for both the Federal Trade Commission and the states to use the tools that we currently have to fill in this gap and continue to protect consumers during these tough economic times. Many consumers throughout the nation are still suffering. They've lost their jobs, are about to lose their homes, or owe an overwhelming amount of debt. And many scam artists are working hard right now to try to take the last dime from these consumers. These consumers are so vulnerable to schemes that promise to make their financial problems go away. The Federal Trade Commission and the states must work harder to ensure that these particularly vulnerable consumers are appropriately protected. And I believe we're doing just that. Now, I've already told you about some of the predatory lending work that the states and the Federal Trade Commission have done over the past decade. That work has been intensifying. Just last week, 7 states announced a $39.5 million agreement with Wells Fargo to settle claims that its subsidiaries, Wachovia and Golden West, before they had become a part of Wells Fargo, had marketed and sold what are commonly referred to as pick-a-payment loans, without fully explaining to the consumers that paying only the minimum amount on their loans would not fully cover the amount of accrued interest, and that choosing to make the minimum payment would actually increase the consumer's loan balance. And of course, unless you've just flown in from a tropical island, which I hope you have because you would have had nice weather there, although it's also lovely here, you've heard about the problems with loan documentation and the robo-signing of affidavits submitted in foreclosure proceedings. In response to inquiries from several state attorneys general about these issues, as well as the federal government, at least one bank, Bank of America, has voluntarily imposed a nationwide moratorium on foreclosure proceedings and sales. Several of the other big players, GMAC Ally, Chase, PNC, have put many, if not most, of their foreclosures on hold. As of now, I'm aware of one state attorney general, Richard Cordray of Ohio, who has filed suit over the documentation and robo-signed affidavit issue. Just this morning, in fact, just about an hour ago, 49 state attorneys general announced that they were jointly investigating this latest twist in the financial crisis. I also suspect that we will very soon hear a response from the federal government about this issue as well. Now, turning from consumers who actually are in foreclosure to consumers who face the threat of foreclosure, the Federal Trade Commission has focused on problems faced by these consumers who are concerned that they will be facing the threat of foreclosure. Just this past June, the Commission announced its own action against Countrywide. That's the same company that the states targeted 2 years ago. The FTC was concerned that Countrywide's loan servicing operation charged homeowners who were behind on their mortgage payments outrageous, inflated fees that often added up to hundreds or even thousands of dollars for such routine services as property inspections, lawn mowing, and other services meant to protect the lender's interest in the property. As a result, even as the mortgage market was collapsing and more homeowners fell into delinquency, Countrywide earned substantial profits generated at the expense of consumers already in dire financial crisis. The FTC obtained a $108 million settlement against Countrywide for these practices, and we're now working hard to return this money to consumers. The states and the Federal Trade Commission have also aggressively pursued mortgage modification and foreclosure rescue scams that prey on desperate consumers who are way behind on their mortgage payments and are in fear of losing their home. These fraudsters collect huge upfront fees from the consumers in exchange for the false promise that they can prevent the consumers from losing their home in foreclosure. Since February of 2008, the FTC has brought 30 enforcement actions targeting foreclosure rescue and modification schemes, and the states have brought over 200 cases, and there are more in the works. Now, these sorts of relief and rescue scams are not just related to foreclosures and to the mortgage market. There are a lot of fraudsters out there who also claim they can help consumers erase their other debts, such as credit card debts or other unsecured debts. While the pitches and the promises of these fraudsters do vary, the scams share two things. First, a large upfront fee paid by the consumer, and second, a failure by the scam artist to deliver on the promise that they can provide any relief to the consumers. Consumers again, pay hundreds and sometimes thousands of dollars to debt relief companies, and they get nothing in return. Stopping deceptive debt relief practices is a high priority for the Federal Trade Commission. In July of this year, the FTC announced amendments to its rules that would prohibit debt relief providers from collecting upfront fees before settling or reducing consumers' credit card or unsecured debt. This simple change, preventing debt relief providers from collecting a fee before they provide any service, I believe, should eliminate a great deal of the fraud that is out there. On the enforcement side, the Federal Trade Commission has worked closely with our state partners to shut down many of the worst players in this sector. Over the past decade, the Commission and state enforcers have brought a combined 260 cases to stop deceptive and abusive practices by debt relief providers that have targeted consumers in financial distress. Now, one special breed of debt relief providers specializes in tax relief, promising to help consumers who have fallen behind on their taxes. Just last week, the Federal Trade Commission sued Americans for Tax Relief. That's a company that's taken in more than $60 million from consumers around the country with their false promises that the company can reduce consumers' tax debts for a fraction of the amount they owe. The company's ubiquitous TV ads are designed to appeal to consumers in financial distress. I'm sure you've seen some of these ads on late-night television. In one ad, Robert and Barbara, who are identified as cross-country truckers, smile and tell the camera, "We owed the IRS $24,000, but we only paid $2,000. The voiceover then tells consumers to call a toll-free number for a free consultation. Consumers who call the number speak with a supposed tax consultant who assures the consumer that they qualify for a tax relief program, that Americans for Tax Relief can help them significantly reduce their tax debt. The consumers pay anywhere from $3,200 to $25,000 for the purported tax relief services. But as you have guessed, Americans for Tax Relief never actually delivers on its promises. And after falling victim to this company, consumers, in addition to still owing a significant amount to the IRS, are out several thousands of dollars that could have been used to pay down their tax burden. The FTC sued Americans for Tax Relief and the company's principals. These are individuals who, unlike their victims, enjoy a life of opulence. They reside in multi-million-dollar Southern California homes, and they drive luxury cars, including a Rolls-Royce, a Bentley, 2 Porsches, and 2 Mercedes-Benzes. Those are some pretty nice cars. A U.S. district judge has issued a temporary restraining order shutting down Americans for Tax Relief, appointing a receiver for the company, and freezing the defendant's corporate and individual assets, that is, their personal assets. The FTC will seek to make these defendants pay full restitution to their victims. So as you can see, protecting consumers adversely affected by the financial downturn has been a priority for us at the Federal Trade Commission, as well as our partners in the states. Today, I've only had a chance to touch on some of the highlights of our efforts. And you can expect to see some more of the same from the Federal Trade Commission in the coming months. And I know this issue will continue to be a priority for leaders in the state consumer protection community, like Attorney General Bullock. As the new Bureau of Consumer Financial Protection begins to ramp up its activities, we'll be coordinating and working closely with the new Bureau, as well as our friends in the states, to help consumers get through this rough economic time and to help ensure that financial reform is a success. Thanks very much for your time, and thank you again for the opportunity to speak here today. So I'm happy to take questions if people have questions about life in Washington, what it's like to move from the states to the federal government, what Senate confirmation is like, or probably more relevantly, some of the things that I had a few moments to talk about. Anything would be fine. Yes, you know what? I should put my glasses down. Yes.
not collecting debt settlement companies not collecting fees before doing anything for a consumer.
Right.
And you said it's a simple change, but
Right.
is there actual plans to make that simple change?
Oh, yes, that, I'm so sorry if I wasn't clear about that. That rule has been finalized, and it is now effective. So it is in place. Now, if you all out here in Montana working with consumers and others around the nation hear that these scam artists are kind of finding a different way around the rules, I really want to hear about it. But I'm very, very hopeful that this will stop a lot of the fraud up front. So
Thank
sorry
you.
I wasn't clear about that. That rule has been finalized.
Thanks.
Sure. Yeah.
The HAMP program that Treasury has initiated is generally regarded as not quite a miserable failure, but close. It has not resulted in a significant voluntary modification of mortgages. Recognizing that you've commented that the banking regulators were a little lax in leading up to this crisis, the question is, what policy initiative, if any, does the Commission have with respect to mortgage mods, be it voluntary or mandatory?
So if everyone, just to repeat the question in case some folks didn't hear it, although you were very articulate and clear about it, what does the federal, well, there were a lot of comments in there about the effectiveness of the HAMP program, which was designed to try to help consumers who were facing difficulty with respect to the potential of foreclosures to modify their loans to try to make them more affordable for consumers. I think that there are a number of people, especially when I was in the North Carolina AG's office, we worked a great deal with the federal banking regulators on the HAMP program. And my experience back then was that it was problematic. It was having problems. So the question, though, was what is the Federal Trade Commission going to do to try to deal with mortgage modification? That is really, unfortunately, not something that we can do. We don't have jurisdiction over banks. We don't have jurisdiction over the lenders. So it really is something, you know, that as Byzantine as Washington is, unfortunately, it really is something that the banking regulators have to deal with. And I fully expect that if the level of foreclosures hasn't worked its way through the system by the time the new bureau is in place, I fully expect that that will be one of their top priorities. It has been, I think, frustrating, speaking from the perspective of the banking regulators, although I'm not one, I talk to them a lot. My sense is that it's been frustrating on the part of by all parties that the program hasn't worked better. Yeah.
It seems to me a lot of what we've heard today is resulting from a lack of financial literacy among a lot of the people that have been involved, and I'm wondering if you could speak to some kind of programs you're going to try to do to improve that?
You know, that's a great question. Are you in the banking community? If you don't mind my asking, are you in the banking community, or do you come, what is your background?
I'm a faculty over here at the University of Montana.
Great. I'm really, really glad you asked that question. I think that's a great question, and I think that that is an issue that is on a lot of folks' mind. And, you know, the question being, you know, is this issue, is one of the ways to resolve the underlying problem that led to this mess, increasing the awareness of consumers and the understanding of consumers about financial issues. When I was in North Carolina, we used a number of settlements that we obtained, including one from Bank of America over its acquisition of Merrill Lynch, which caused a lot of, you know, it was a big brouhaha that a lot of you had heard about. We were going to use that money, which was a great deal of money, to enhance our financial literacy programs. And I think there's an effort on the part of the states as well as the federal government to deal with that. But I think there's another view, which is that if you have to spend a lot of time educating consumers about the complex financial products that are being offered, the question is whether the consumers need to be educated or whether the products need to be made simpler. I mean, there's two sides to it, right? And I think that one of the perspectives that is that Congress has inlaid into the new Bureau is the need to try to make some of these products more intelligible for the average consumer. Clearly, we want to get financial literacy up, especially among young kids. I mean, to the extent that you can bring those kind of issues into the junior high, into high schools, incredibly important to do that. But I think that there's a counterbalance to that, which is when products become so complex that even the financial investors in Wall Street who are trying to figure out what tranche they have and what the risk is, when they can't figure it out, there's something too complex about it. So I think there's two sides to that coin. A really interesting question. We could spend an hour talking just about that. So thanks for asking that.
And the relationship between the new bureau and the banking regulators.
Well, the new bureau will be regulating the banks, at least with respect to consumer products. So, you know, one of the things that, you know, again, I started working when I was 5 years old, but one of the things I did many, many years ago was I was a general counsel of Vermont's Department of Banking and Insurance. And so I do understand the way regulators think, and banking regulators and insurance regulators in particular. And you know, they have a different relationship. Regulators have a different relationship with their constituency, that is the regulated players, than do, say, state attorneys general or the Federal Trade Commission, which are primarily law enforcement operations. I think the new bureau will be designed to have more of a relationship that's like a traditional banking regulator, but yet also share some of the important attributes of law enforcement. So I think my hope is, and I think the design is, that the bureau will kind of fall in between a traditional regulator and, you know, a stronger law enforcement kind of entity. But the devil will definitely be in the details on this one. A lot will depend on who the director becomes. A lot will depend on the people that are brought in and their perspective. A lot will depend on the rules that are going to be written. And you heard, you know, the number of rules and studies that need to be conducted over the next few years by the new bureau is really astronomical. So a lot will depend on what happens over the next few years, and hopefully we'll all continue to watch and make sure that it goes the right way. Anybody else? Well, thank you so much for having me here today. I really enjoyed it, and you have a beautiful state, beautiful river, and keep up the good work. Thank you.